The best of Money Matters. Market View on Money FM 89.3.
Hi, I'm Willie Keng. You are listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch. Now, Asian stocks staged a modest recovery on Tuesday, rebounding from the past 3 trading days of what was a garden variety correction. Most regional stock indices saw sharp gains today, with the Nikkei soaring nearly 7%. This was lifted by US technology stocks, while some deep buyers emerged after 3 days of sharp declines. Meanwhile, the Chinese yuan depreciates to its weakest level since 2023. Now, in Singapore markets, the benchmark Straits Times Index was down 12% over the last 2 weeks. A crisis or a buying opportunity? And Singapore blue chips are buying back shares on Trump's post-tariff sell-off. So how do we make use of all this? With that, let's unpack all these developments with Kelvin Wong, Senior Market Analyst of OANDA. Welcome to the show, Kelvin.
Hey, thank you for the invitation, Willie.
Over the last 3 trading days was a bloodbath, and we are seeing modest recovery today. I just want to get your thoughts here, Kelvin. How has the STI fared so far, and what's driving markets?
Yeah, if you look at the STI today, it's rather disappointing as compared to its intraday performance versus the other major Asia stock indices, where we see a positive close in the Nikkei 225, which is up. The Nikkei 225, which is up by 6%, and even the Hang Seng Index is up by 1.5%. And what we see is that the STI continues to underperform by a loss of negative 2%, dragged down by the higher weightage banking stocks in the STI, where all 3 of them actually was deeply in the red by a range of negative 4% to negative 3%.
And what are the biggest movers here, and any surprises so far, from the Straits Times Index?
From what I see over here is it doesn't surprise me too much. Why? Because given that the Singapore economy is rather pretty much dependent on external factor, and given this shock that we see in the last week or so, very likely that it will actually dampen Singapore economic growth. So the STI actually reacted accordingly to the weak macro environment.
Yeah, speaking of the Singapore markets, we are looking at some of the Singapore blue chips, sort of taking advantage of the markets here. A couple of them buying back shares on the post-Trump tariffs sell-off. You have DBS, which bought back about 1 million shares at about $39 million. You have the Singapore Exchange, which bought back about $1.8 million worth of shares, and the Singapore Airlines as well, which also repurchased about 500,000 of shares at about $3.1 million. Kelvin, how should investors make sense of this situation?
So if you look at from a longer-term perspective, yes, we start to see the Singapore stock market as a whole in general fall down to a much more attractive levels based on certain valuation. You look at forward-looking 12-month PE ratio, 12-month sales to price ratio. Yes, they have fallen more to much more cheaper level versus 4 weeks ago. Yes. What's interesting over here is that, number one, let us address from a very short-term perspective. From a very short-term perspective, for close to about 7 days, the STI has declined for 7 consecutive days of losses. So today it touched a key support level at this 3,450 level. So this 3,450 level is in fact a very long-term previously range resistance that is in place since 2018. And it has been taken out on September 2024, and today it actually retested this kind of a important former major range resistance down to a pullback support at this 3,450 level. So for sure, 7 days of consecutive decline has led to various momentum, we call it indicators deeply in oversold territory, coupled with this positive corporate news flow from buybacks from the major, we call it a higher weightage STI component stocks. In the very near term, there could be signs of potential rebound taking shape. So resistance level to watch will be that broken down 200-day moving average on Monday, which is at 3,640 level. So from a longer term perspective over here is that there will be still headwinds coming into play because of this lack of clarity that's coming out from U.S. White House implementation of this trade tariffs plan. So going forward, if we can't see a surpass of above that 3,640 level on the STI, potentially there could be some form of further weakness coming back into play again.
Yeah, I mean, speaking of the STI here, I just want to focus a bit here on our constituents here. I mean, the STI was down 12% over the last 2 weeks. Yesterday, its decline also marked one of the biggest intraday declines here. At one point, I mean, right now, it's down about 3,500 points of what you've mentioned. Some big questions I want to ask, Kelvin. Do you think at this point it's a crisis or an opportunity for investors, in our local stock market?
Okay. For short-term investors, short-term technical investors, that means we're talking about looking for only a time horizon of between 1 to 3 days. Yes, this is definitely an opportunity because of that overstretched decline and with that risk of the mathematical momentum indicator hitting oversold region, there could be a potential chance of a rebound, but that's for very short term. But if you are looking for a very longer term horizon, let's say if you are a retiree looking to build your investing nest at this point in time, perhaps this may not be an opportunity yet at this juncture because there are still headwinds over the horizon, especially in the U.S. Because do not forget over here is that U.S. is still one of the bigger market where Singapore is pretty much reliant on as well.
And what are some of the risks here which investors would actually have to pay attention to for, let's say, longer term investors?
So the risk for sure is still now pretty much centered on the state of the U.S. economy. Number one, there's this growing risk of stagflation. Okay, so this has been being acknowledged by various Federal Reserve officials in the last 2 weeks or so, based on their public speeches. So right now, U.S. right now is in a stage where, for a very, very long time, since 1970s, 1980s, there is a risk of an economic slowdown coupled with sticky inflation due to the fact that of this potential tit-for-tat tariff measures coming out from nations that's being targeted by U.S. reciprocal tariffs on a higher scale. So with this form of stagflation risk that is growing, previously in the past slowdown, I would say cyclical slowdown in the U.S. economy, that has been more or less negated by the U.S. Federal Reserve coming in to provide an liquidity backdrop, and it's i.e. they start to kickstart a much more aggressive interest rate cut cycle. But if you look at the various Federal Reserve officials speaking, even Powell himself on last Friday, he is more concerned about inflation risk rather than growth risk over here.
Right.
So that's why in the near term, I don't expect the Fed to kickstart a rather aggressive interest rate cut cycle. Like the last one it did was during the pandemic, where that could actually potential leave risk asset back to positive territory again.
Yeah, I mean, you mentioned about the potential delay in rate cuts by the Fed, also the potential risk in stagflation here. I mean, if we just look beyond that, do you think the STI would drive past 4,000 points? And if so, what do you think are the key drivers here if we are looking at the STI, punching through the 4,000 mark?
So the only thing to see this positive catalyst by the STI breaking through above the 4,000 level is that we need to have a very, very we call it significant geopolitical play changing landscape. That means, i.e., right now what we're seeing right now is previously U.S. is being done as a big brother against the rest of the world. That means they advocate free trade. You trade with us, you benefit, right? Them as a biggest consumer. But right now, what U.S. is doing now is that they are forcing the whole world to allow it to become the biggest manufacturer. All right. So by doing that, that creates a lot of headwinds into the global village over here, or the global economic landscape. So the only way is who can take up the slack as being the biggest consumer right now. So market participants, even myself, I'm watching very closely the relationship between China and other nations. Okay, so recently, previously, we start to see a very unlikely alliance between China, Japan, and South Korea, talking about some kind of deals that to negate this reciprocal tariffs that's being hit on them.
Right.
And right now, perhaps, would there be a different sphere of trading bloc taking shape where Singapore could be part of it, that means i.e. excluding the US, then that could potentially be a potential catalyst where the whole world starts trading among themselves without including US into this sphere. So that perhaps could give a bit of catalyst of the STI to actually surpass above the 4,000 level. That means, i.e., a new form of a world trade agreement where other nations come together, excluding US. So that could be a possible scenario. But before we reach there, there could be a much more kind of a negative adjustment that could take shape first.
Now, speaking of China here, Kelvin, I just want to move on to the currencies. We have seen Chinese yuan depreciate to about 7.33 against the dollar, weakest level since late 2023. I mean, what do you make sense of the impact of tariffs on the Chinese yuan? And do you think this is healthy for the Chinese economy?
Okay, yes. So I want to address this question is most market watchers ignore the fact that in the last 20 years, U.S. has become a lesser export destination to China. That means we're talking about U.S. itself. Yes, they are still a significant, we call it export for China export, but their market share has dropped significantly. So from previously about 20 years ago, it was at 21%. That means then comparatively last year, it dropped to 15%. So if you look at it in a way that over here is that the U.S. market is not a rather significant export destination in the last year or so. I mean, the percentage of shares dropped from 21% to 15%. So what I could see over here is that I do not expect any significant devaluation of the Chinese yuan against the dollar.
Right.
That means what I could see over here is just a normal kind of adjustment done by PBOC to actually, we call it negate any negative feedback loop that could actually see from these trade tariffs. But what I'm interested in watching over here is that in the last few weeks, even before the release of the reciprocal trade tariffs, the dollar has been weakening against other major currencies like the euro. And because of this weakening of the euro against the weakening of the dollar against the euro CNH rate has starts to see significant movement and breaking above the $8 level. Okay, the 8 level. That means the euro CNH breaking above the psychological 8 level. So that could actually imply that the market movement over here is that the yuan need not to be weakened so much against the dollar because other major currencies has really strengthened against the dollar.
We have been speaking with Kelvin Wong, Senior Market Analyst of OANDA. Thank you so much for your insights, Kelvin.
My pleasure. Really.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.